In today's video, I'm going to teach you a very powerful trading strategy which is used for intraday trading and is highly suitable for low time frames like 5 minutes and 15 minutes. In this strategy, we use two indicators, RSI and Bollinger Bands. RSI is used with its default settings and we use its overbought and oversold readings in this strategy. Our trade setup is formed when RSI hits either an overbought or oversold level. The market is considered to be overbought when RSI goes above 70, and on the other hand, it's considered oversold when it moves below 30. These situations signal a possible reversal in the market, but as you know, many of the times these are false signals and we need to filter them and identify the correct ones. So rather than just immediately buying or selling in the hope of reversal in the price solely based on RSI, we add two Bollinger Bands to identify the points of the price that are really overextended. If you're familiar with Bollinger Bands, so you know that in Bollinger Bands with its default settings, we have a moving average with length of 20, which is the middle line, and then the upper band and lower band are two standard deviation from the moving average line. One use case of Bollinger Bands is for identifying overbought and oversold conditions. When the price reaches to the lower band, it's considered oversold and possible upside turning of the price, and when the price reaches to the upper band, it's considered overbought and possible downside turning of the price. This is based on a statistical principle which says that around 95.4% of values are within two standard deviations of the mean, and the more we get close to the standard deviations, the probability is lower, as you can see on this chart. Based on this principle, if we consider three standard deviation from the mean, the result is that around 99.7% of values are within three standard deviations of the mean, and reaching to this extreme levels of price near three standard deviation from the mean has much lower level of probability in compared to two standard deviation from the mean. So in this strategy, we also use another Bollinger Bands with adjusted setting of three standard deviation from the mean, which we use it for identifying extreme movements of the price. Alright, now let's see how the trading setup in this strategy looks like. As I've already explained, we have three indicators on the chart: RSI with default settings, one Bollinger Bands with default settings, and another Bollinger Bands with three standard deviation from the mean. And the time frame that I'm using in this video is 5 minutes. In the first step, we must wait for overextended moves. On the downside, we must wait for the price to cross below the lower band of the three standard deviation Bollinger Bands. And alongside with this, we must see that RSI goes below 30. And for an overextended move on the upside, we must wait for the price to cross above the upper band of the three standard deviation Bollinger Bands. And alongside with this, we must see that RSI moves above 70. Both conditions, I mean overextended move beyond Bollinger Bands and RSI overbought oversold reading, must be satisfied simultaneously. For example, here on this chart, you can see that the price moved below the lower band of the three standard deviation Bollinger Bands, and at the same time, RSI also moved below 30. And this condition shows that we had an overextended move and we may see an upside turning of the price. Then in the next step, we must wait for a green candle that opens and closes well above the lower band of the two standard deviation Bollinger Bands, and at the same time, RSI must also be backed above 30 level. It's important that the entire body of this candle is above the two standard deviation Bollinger Bands. For example, you can see that here we got a green candle and its body is entirely above the lower band of the two standard deviation Bollinger Bands, and it's also well closed. Actually, its body totally engulfed the body of the previous candle. So we buy or we enter a long position here at this point. The stop loss for this trade is placed below the low of the previous candle, actually the candle that opened and closed above the two standard deviation Bollinger Bands. And for the profit target, we try to be conservative and take our profit early, because although we have signs of increased upside momentum on this chart, we are entering against the short-term direction of the market. So we take our profit on the upper band of the two standard deviation Bollinger Bands. In another example here, you can see that the price crossed above the upper band of the three standard deviation Bollinger Bands, and this is happening alongside with RSI reading above 70. So we can say that here we have an overextended upside move and the price is probably going to turn down. Here we got a red candle, the body totally below the upper band of two standard deviation Bollinger Bands, but it's not a well closed strong candle. So we wait, and here after this green candle, an acceptable red candle formed which totally engulfed the previous candle. So we enter a short position here at this point, and similarly the stop loss is placed above our triggering candle and we take our profit when the price reaches to the lower band of the two standard deviation Bollinger Bands. Please pay attention that although this is a very low risk and high probability trading strategy, but it doesn't provide 100% guaranteed signals for making profit, and like any other trading strategy can generate false signals. It's really important to place stop loss so you can protect yourself in the case that the market suddenly goes against you. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.